Good afternoon, friends. After a regenerating 50th RRC, which was thoroughly enjoyed by all the delegates, I welcome you all to this 7th study circle meeting. As we are all aware, as professionals, the union budget is more than just a financial statement. It's a document that reflects priorities, aspirations, and numbers with a roadmap for growth. As professionals, we have the responsibility to interpret the changes, the implications, and also the impact on the direct and indirect taxes burden on all of us as individual citizens. Today's study circle meeting is enriched by the presence of expert speakers CA Abhitan Mehta and CA Amitabh Khemka, whose valuable insights will guide us in understanding the nuances of this financial policy and tax reforms of the Modi government. As the saying by Benjamin Franklin goes, an investment in knowledge pays the best interest. By learning from such expert speakers present today, we invest in our own ability to make informed decisions with clarity in thoughts. I encourage all of you present, here physically and online, to engage actively, ask questions, and share your professional experiences, which will help us decipher the nuances of this Union Budget of 2026. On behalf of GSTPAM Study Circle conveners and chairmen, I extend a warm welcome to each of you and look forward to a day of deliberation and shared learning. I now hand over the podium to our president for his remarks.
Good afternoon, one and all. Well, as we said, uh, every time there is a budget, there is a surge of what is good for us, what is not good for us, what is going to be the future in the next 1 year. And that is why every study circle after the budget is on the basis of our finance bill. Now, that is why income tax, lot of our members practice income tax. But but originally we are a GST association. But now that income tax itself, all members partially practice income tax also. So income tax itself is a very important. And let's face it, income tax is the main core of the finance bill. So that is why I genuinely thank Abhitan ji for accepting our invitation and enriching the participants. Most of you who are online as usual. I also request aage jaake please come physically also. But whoever is there online and physically, I welcome each one of you and I wish you happy learning. Thank you. Thank you.
I now request CA Umang Talati to introduce the learned speaker.
A very good afternoon to one and all. It is with great honor that I get to introduce a dear friend of mine, C. Abhitan Mehta. In spite of his sore throat today, we appreciate his commitment to deliver the lecture today on income tax. So, Abhitan is a fellow chartered accountant and a law graduate, currently leading the transaction advisory services at CBV and Associates LLP Mumbai. His professional journey began with articleship at PwC, followed by post-qualification experience at Bansi Mehta. He later worked as a leader transactions at BDA LLP directly with Sri Gautam Doshi, where he honed his experience in diverse and complex corporate and family transactions. Abhitan has been advising India's largest conglomerates, unicorn startups, and global investors across various sectors like banking, financial services, pharmaceuticals, metals, oil and gas, manufacturing, e-commerce, startups, entertainment, and a whole gamut on complex mergers, acquisitions, restructuring, and tax strategies involving holistic considerations of multiple laws and regulations, including in particular the Income Tax Act, GST Act, international tax, corporate laws, SEBI, IBC, FEMA, and accounting and auditing. Abhitan had the privilege of working on some of the most high profile transactions in the country, from billion-dollar insolvency takeovers to succession plannings for families featured in the Forbes 100 to the largest demerger of a listed company. His expertise has been recognized by the Institute, which nominated him as a special invitee to a select group of professionals reviewing the Income Tax Bill 2025 and making recommendations to the Lok Sabha Select Committee, Niti Aayog, and the CBDT. Within the professional fraternity, Abhitan holds the distinction of being the youngest ever chairman of the Direct Tax Committee of the Chamber of Tax Consultants between 2022 to 24 in its 100-year history, and has served on multiple key committees, including the Law and Representation Committee, the Technical Committee for the Centenary Year, and the RRC Technical Committee. He is also a member of the International Fiscal Association Indian Western Region, and an ex-member of the International Tax and Ind AS Committee of the WIRC of ICI. He has regularly been interacting with several senior counsels of the Supreme Court and High Court for advisory and litigation matters of his clients, and is a regular speaker at various conferences, including the ICI, IFA, BCAS, CTC, and Tax Sutra on intricate subjects. So, with this, I request everyone to welcome Abhitan. I request the president to offer a small memento as a gratitude from the association. With this, I hand it over to Abhitan for his opening, for starting the session.
Yes.
Yes.
Thank you, Parth bhai, Ajay bhai, for the invitation. Thank you, Umang. Because of my sore throat, you gave a very detailed introduction so that I have to speak less. Uh, Friends, coming to the topic of finance bill. Uh, One is the changes which are there, which we'll be discussing over next 1.5 hours. It is equally crucial the key policy indicators in the context of tax, what the FM has underlined. I would classify, yes, 2 3 baskets of it. Primarily, if you see, after a long time in income tax, In GST, we had decision of safari retreats being overruled retrospectively. After post Vodafone broadly, there has not been any such a significant retrospective amendment. There have been few here or there, but where thousands, tens and thousands of appeals were pending before Supreme Court, four issues have been retrospectively proposed to be amended. This is a big policy shift to the government's underlying theme of that we don't like retrospective amendment. Yes, there could be a silver lining that these were procedural errors, compliance errors, and not computation issues. All are linked to how, when a assessment order should have been passed, how it should have been passed, what time limit it should have been passed. So it is all those nitty gritties. But it cannot be done away just by classifying them as procedural issues. The assessing officers are the first ones responsible to uphold and implement. They expect us to do it. And where there is a miss from their side, we have a slew of retrospective amendment. What happens is why I'm making this as a first point. Every other client has made has filed a writ petition on technicalities or has taken grounds in appeal is a meritorious case. High courts are broadly in favor on the subject. And now with the amendments, what message will go to the board? The Indian boards, the foreign boards of operating in India, the foreign MNCs coming to India, that again India has done for retrospective amendment. What messaging are you sending? Is that messaging worth the quantum, the alleged quantum you'll possibly recover by going through these assessments? Is a question to ponder. What really triggered such huge retrospective amendments wherein the FM is not even mentioning them in her speech? So are they so trivial that they don't call for a mention in the speech? Or the speech is all about being hunky dory, what is the positive changes? And then when you see the fine print, you understand that this level of retrospective has been brought in for the first time. In the similar spirit, we have an amendment for sovereign gold bonds. For sovereign gold bonds which were redeemed on maturity or any redemption, even if you ask for an early redemption, there was an exemption to capital gains tax. Without providing any reason whatsoever, unless you are the original subscriber to the bond, you won't be entitled to the capital gains exemption. Further, even if you are original subscriber to the bond, you have to hold the bond till maturity. Earlier, you could have asked for an early redemption after the lock-in, say 5 years, and you could have still got a capital gains exemption. In last couple of years, we had multiple amendments in capital gain on MLDs, specified mutual funds, that they should be deemed short term and full rate should apply to equate them. The interest debt instrument should be taxed at full rate was the philosophy. But broadly, except MLDs, all mutual funds were prospectively covered. Here, the existing holders of sovereign gold bonds will be hit by a tax liability, which was not factored when they purchased. So even the market price didn't factor that there would be a tax outflow at the end of the day. It was looked at as more a tax-free yield if I am going to hold this as a maturity. Why a policy shift? What are we trying to garner? By in between changing the policy, you come with a new sovereign gold bond scheme in that you say this is not tax free or this is the condition. Now somewhere in between you bring up and show this is difficult. In the same spirit, you have this land acquisition exemption. Section 96 of the Land Acquisition Act broadly is giving a complete exemption to all the taxpayers. And we had a circular giving the exemption, and which was 2016 circular used to be applied. Now we say the exemption is only for individual HUF in the act. The section 96 continues as it is. What policy point are we trying to draw? If there is a compulsory land acquisition from a partnership firm or from a company, that is also a central statute. You please go and change. There the exemption continues, your circular continues, but the exemption in the Income Tax Act is restricted to individual HUF. Possibly this may be addressed when the bill is being passed. Otherwise, one is having doubts on the policy certainty what it always had. To make statements that Indian policy on tax is very clear, will go in one line. Tiger Global is another facet, but that is a court ruling, so I would not put it. But here, it is the legislature who on his own is trying to amend things in a not so cordial way. Coming to what is good, yes, on a broader policy, there is no change. Broader policy, we said that we don't want to, the tinkering done in the primary provisions is lesser. If you see, except buyback, 2, 3 others, computation continues to be as it is. So, yes, on the policy side, that is the silver lining, if I have to put it. But at what, uh, but will I say I know the policy of the government now? Again, the answer is no. Because we said we want to do away from the exemption regimes, we want to do away from any deduction, no profit linked incentives. Now we again felt no data centers, toll manufacturing is to be promoted, so we'll have some schemes. So too much, a decision of convenience going on. Yes, we'll go through each one in detail, but a fundamental point is that if in October you are passing Income Tax Act 2025, saying that this is the new act, it is going through parliamentary committee, going through Niti, going to everyone, you are saying no policy change, nothing, this is what we want to, take forward. In February, you have 120 changes to it. 10 are typos, but others are very fundamental changes. So when it came to parliamentary committee, I didn't tell them that assessment and penalty would be together now. I didn't discuss reclassification of penalty to fee or what tinkering I want to do to prosecution or computation. There I just that there is no policy change. And in 4 months, there was such a high need of policy changes that we are here discussing. Because when Umang Bhai first invited me, I was like, there shouldn't be anything. I think so. My throat wants me to stop bitching on the government now and move to the topic proper. So now coming to the, is there a pointer? Next नहीं हो रहा है. Okay. So no change in headline rate. So yeah, the slab rates, company tax rates continues as they were. MAT is reduced to 14% from 15%. Taxation of buyback we'll see in detail. That has been moved from dividend to capital gain now. for unexplained cash credit for unexplained income. The base rate has been reduced from 60% to 30%, but we'll see the various permutation combinations if you offer unexplained income at the time of your return filing. What is your tax rate? Today's Economic Times article even summarizes that if you offer it when the assessment notice is received, if you offer after assessment without litigation, and if you lose in litigation. So you'll have four scenarios broadly in which you could offer to tax unexplained income. Now, the theme is there are two themes, if I have to say. One is that reduce penalty if you don't file a appeal. So they are incentivizing that you don't litigate by putting a cost to your litigation, a risk, a higher risk to your litigation. That if you settle now, you pay 10 rupees. If you litigate, you'll pay 20. So they are putting one more dimension to your risk assessment, that whether you should litigate or not litigate, by providing a immunity to prosecution and a reduced penalty if you pay after the assessment. And first time, I think so, we have that once you have received a reassessment notice, if you surrender extra income, you have an additional income tax on that, but then you are through. You will not have a penalty consequence. So very technically, even today when you receive a reassessment notice, you can declare higher income. There was no debate or no restriction on doing so, and people used to do, who used to understand this is the error, this is the mistake. Your at least penalty was originally being saved, but then they have amended the penalty law to not take into account the newly declared income. But now they have said that if you declare, we'll levy a additional 10% tax, additional income tax, and you are through. So last two bullets are very specifically encouraging uh, the reduction of litigation. Equally important is first time we are getting in a concept of automatic lower withholding tax certificate. So the details would come in, but what one is gathering from the explanatory memorandum and speech is that you punch in your basic data, what is your past track record, losses, income, and based on the formula, what should be your withholding tax rate. So they are doing away with assessing officer being the determinative person, rather than formula will determine that are you eligible, what are you eligible. Who would be eligible for this, one doesn't know. Whether they'll have a criteria like 3-year loss, fixed passive sources of income, or for normal business income also they'll give, what monetary caps they'll have, all those will come. But the initiative is in a positive side, that we are going towards a rule based system, that we know that if I fulfill the conditions, I will get a lower withholding certificate, and it doesn't depend on the officer setting. So would be very helpful. We'll have to see how that subject evolves. Friends, on buyback, I don't know why, but is somewhere getting much more importance than the subject should. Buyback has been the taxation of buyback. If you see the entire mechanism of taxation, from 2013 there was a change, 24 there is a change, 26 there is a change. So it has always been a patchwork. That in what happened before 2013 was Mauritian treaty was being used. So you do a buyback of shares, the money goes out, capital gain is taxable in Mauritius, so no tax in India. If they would have declared dividend, they would have paid at least 5% tax in India. So that was the primary problem statement. Another was for listed company again. Listed company, if you do a buyback, the 1038 era, before it became taxable, you do a buyback, again, you don't pay any tax, no dividend tax is mitigated. So then we first got 115 QA to say that there would be an additional income tax on the company itself. In first instance, we didn't cover Indian listed companies. We were only targeting the foreign companies. In later on, we also covered after a couple of years Indian listed companies under buyback. Even then, we had so even then the rate was coming to say 18% was the rough rate. So then the complaint started that Wipros and Infosys and everyone is using buyback as a route for dividend. The promoters who were supposed to pay 36% are getting out at sub 20% rate. So then we felt, no, this is not doable. We need to plug this. So we went to the dividend route. So let us, for this is not capital gains, this is dividend. So in 24 we got to dividend route. Huge uproar or in the market that you are collecting tax from residents uh, as 36% and you are giving a benefit to the non-residents, because in non-resident treaties the rate is 5% or 10%. Earlier you were collecting at 18% roughly. So but they felt no, this is what they brought in 24. And now, because of this leakage, they thought, let us have hybrid. Let us collect tax from everyone possible. So, how will a non resident pay higher tax? He'll pay higher tax in capital gain because the treaties are broadly amended, except the old Mauritius grandfathering. If it is dividend for non resident, he will only pay 5%, 10%. If it is capital gain, he'll pay full 12.5 plus roughly 15% tax he'll pay. So okay, we'll keep it as capital gain. But then we said the Indian promoters will go out. They are paying only at 12.5% plus 14.95 they'll pay. So how should I collect from them? They should be paying as dividend as 36. So I'll put an additional tax. I'll call this as capital gain so that the treaty benefits of dividend is not available. And then for the promoters, I will levy a additional income tax which will bring their rates to 30%. If they are non-corporates, if it is corporate, it is 22%. So we want to tick box that we collect from everyone. So only non-promoters, basically broadly, if one has to put it, the public shareholder of listed company will pay capital gain tax, which they used to even otherwise pay if they sell the shares in the market. They don't have to, really participate so much in the buyback. Promoters, it is difficult to place huge lots in the market. So for them, it is 12.5. For others, it is the highest we can get. What level of complications this will bring in if we have to just spend 10 minutes on the subject. So what has happened if we have to just compare what we would be doing till 31st March and what we'll be doing from 1st April? So right now it is dividend. Now going forward it would be capital gain. Right now for dividend calculation you don't get cost of acquisition. Now for capital gain you will get cost of acquisition. Dividend, it falls under income from other sources. And cost of acquisition is considered as short term, long term capital loss. So you have other sources income, your set of rules of business loss, other losses will apply accordingly. Going forward, it is capital gain. So your set of rules would apply that this is capital gain. And additional income tax also you have to pay under 69. Big difference. Being dividend, you could get ATM benefit if there is a company in between. If I have a operating company, there is a holding company, and there are promoters. If I do a buyback by the operating company, the money goes to the holding company. Being dividend in nature, it can upstream and take ATM deduction. Now, this upstreaming is not possible because has to pay tax. And also on ESOP rights, this was lesser used, but there is a proposition that ESOP rights were always taxed as under capital gain and not under dividend was clear. But now ESOPs with the promoters will have this 30% rate. So there is a change for them. If it is to employees who are not promoters, it will be at 12 and a half. But employees who are promoters, they will be for ESOP buyback be taxed at 30%. So it is just this is the breakup on how they reach 30%. Your baseline 12.5 plus they do 9.5 to reach 22, 12.5 plus 17.5 to reach 30%. The another problem is for foreign companies. Foreign companies, you foreign shareholders, you under 115A, you have a cap on dividend at 20%. Whereas for buyback, there is no cap. So a foreign shareholder, if he is a promoter, he'll have to pay 30%. Whereas if the company would have given just a dividend, he would be paying 20%. Even in the domestic law, leave aside the benefit of the treaty. We'll come to. So now there is a additional tax, the sin tax on 12 and a half plus to make it 30 is to a promoter. Right now we don't use the term promoter in income tax. For any tax consequence, there is nothing as promoter. So now we have gotten a new word, promoter, for Income Tax Act. We are saying for listed companies, you go by promoter as per the SEBI buyback rules. And for unlisted companies, you go by the Companies Act rule or whoever holds more than 10%. So that is how we are putting it. SEBI, the disclosures are in public domain. Both promoter group, both would be covered, no debate. Now coming to private companies. Coming to private companies. Private companies, what is promoter? No, frankly, I was looking at it for the first time. कि private company में भी promoter है. So there is a definition in Companies Act which they have cross-referred to, that your name is in draft offer letter or identified in annual return. Another is controls the affairs directly or indirectly. And third is in accordance with whom board is accustomed to act. So if you see, last two are very subjective. Who controls the affairs directly or indirectly? You can name one family member, the patriarch, that he controls. Second is in accordance with whom the board is acting. Again, the same patriarch. But what about his family members? Really, there is no definition or no reference. Are they promoter group, Only thing is draft offer letter is again not relevant. Only thing relevant which boils down is your annual return. What you have shown as promoters in annual return. And this is the limited guidance on the subject. So very theoretically, if all the family members except the patriarch can be non-promoters. Yes, each one should hold less than 10%, otherwise you'll be hit by the other section, other limb. But there is nothing that relatives of the promoter, relatives, or the family put together, companies controlled by the family members, entities controlled by the family member. You just see the definition of promoter group which is there in SEBI. Promoter, immediate relative, body corporate which is subsidiary holding more than 20%, body corporate, immediate relative, firm, HUF, blah, blah. It is a good lengthy definition. This is just some extracts of it. But that is all for SEBI. That is all for listed company where as such you have quarterly disclosures. Whereas here it is just annual return. And again, no extensive definition of promoter for annual return. It's good if it is annual return, but what? Only the person who directly or indirectly controls the affairs. So, generally, any family members who are not involved in the management or day-to-day functioning of the company certainly don't control the affairs. So, you have for the fourth time changed the regime. You have gotten the novel concept of promoter this time. Why can't we, be more elaborate on the subject? Why generally one would say, why are we, doing a half-hearted effort? This is just the tip of the iceberg. Now, if you see SEBI, there are exclusions from promoter definition for AIFs, banks, mutual fund. These folks also invest in the private sector. And what stake they take is generally more than 10%. So they are promoters for private companies, but they are not promoters for listed companies. There huge litigation, yes, if identified. The tax is on the shareholders and not on the company. So how will you trace? How many assessments will you make? The law has to be more clearer. Now they have used the word 10% shareholding directly or indirectly. What do you mean indirectly? What is the pass through you want someone to look at? It is easy to write directly or indirectly. Income tax has always looked down on the phrase directly, indirectly. We have Bombay High Court in 40A3, which is another anti abuse that you cannot overpay. It says if a company is holding shares, its holding company cannot be said to be holding shares indirectly. Corporate whale cannot be peers, Bacha Gazdar stands. So, what will you cover by indirectly? Whether you look through a partnership firm, you look through a trust, you look through a HUF, or you will not look through anything unless you positively establish that that person was holding for you indirectly. It was acting on your instructions. That is what indirectly would mean. That is how in DTAA we have beneficial ownership test being laid down. If you want to provide a pass through, provide a clear pass through. Then they are using the word shareholder who holds the shares. In case of Cat 1, Cat 2 AIF, the shares are with the trustee company. The taxation is in the hands of the investors. So investors will not have to pay because he is not holding shares. whether the shareholder will be a registered shareholder or a beneficial shareholder. Because now if I even put my shares on pledge, the shareholder's name changes, though I am entitled to that dividend income. But and now you have old Supreme Court which says that it is only registered shareholder. You don't have to, but the process today to move the registered shareholder even in case of a pledge is there. And for startups, how will you calculate 10% of shareholding? You have written 10% of shareholding. Do I have to aggregate everything? Equity share, preference shares, class A shares, class B shares. 10% of what? Total paid up value, total number of shares, total voting rights. So we're just opening another Pandora's box in one way. Yes, sir.
So in case of family trust who are shareholders in a company, how will the promoter be defined in that case?
So it depends on annual return and 10% rule. There is no definition otherwise. You have to identify, to my mind, at least one person who controls.
So that would be the trustee per se.
Not necessarily. It may be the managing director, maybe the protector, depends on the fact who is really running the business at ground zero. That person, I would say, is the person controlling. May not be a shareholder at all. See, most of listed companies, the promoter holds through trust. They are not direct shareholders.
Yes.
They are beneficiaries. They are not even trustees.
Yeah.
But the control still is with them when it comes to declaration for the listed company. So now coming to small shareholders, we are saying this is not dividend, this is buyback. So buyback will be, so capital gain, flat rate, 12.5. No benefit of slab rate. Now to reach 12.5 as rate is slightly higher than earlier. There is no benefit of chapter 6A. Earlier I used to get chapter 6A benefit. Rebate, debatable, practically no, technically possible. Very interesting question whether I'll get for listed shares the 1,25,000 limit under 112A, now 198. Because if you see the reference in 198 only says that this is a capital gain, in 69, basically 46A says capital gains referred to in 198. What is referred to is full capital gain. Only when it comes to computation, it says capital gain more than 1,25,000 into 12.5. So for additional income tax, whether you will get this threshold deduction or not clear at all. Logically, it should. But as you rightly put, argue. The era is of utility. What utility allows is the. Yes. And rebate, again, two views. Logically, you should get. Utility was allowing for the longest time. One fine day, one did some possible reading of the subject and did away with the rebate. Again, your additional income tax has been plugged into section 69, earlier 46A, has provided the rates of tax directly. That whatever is the capital gain on buyback, you please pay the additional tax at 15%. So what will happen about section 54 deductions? What will happen about carry forward and set off of loss? So those questions are not answered, but there is a what will happen if there is chapter 6A? How will you deal with all those things? Because you always had charge, computation, then rates of tax. Here in computation, before set off and deductions, you have provided a tax rate, a multiplier capital gain into so and so. Always 112A, everything carries a language that forming part of total income. That is after set off, after deduction, you compute, and if it is then forming part of total income, this is the rate to be applied. That has been short circuited. No intention, but the present drafting carries this problem. Important point that section 50 CA will going forward apply to all buyback from 1st April. Earlier, buyback was one of the ways where you could have bought back the shares at token value and said that 50 CA doesn't apply, 56 to 10 doesn't apply. So even a token value buyback is outside the tax net. But now, because it was dividend classified as dividend, now being classified as pure capital gain, 50 CA will apply. Now, when 50 CA applies, whether it will apply on the entire amount or it will only apply, so whether it will apply for additional income tax also, or it will only apply for 12.5%. The view seems to be it will apply on the entire amount, and it is not that it would be restricted to 12.5%. Because for additional tax, it is the capital gain referred to in 112. So when you'll go to 112, you'll have you would have given the effect of 50 CA. Another problem, now redemption of preference shares will be covered under 46A, was always covered under 46A. 222F, present deemed dividend taxation of buyback, only covered buyback in accordance with section 68 as per 61 Act and as per section 68 in the 25 Act. So only 68 were covered. So 230 schemes being covered or not, what is another point. But redemption of preference shares was in section 55 of Companies Act and therefore was not covered by this deemed dividend. Rather, there was a 222 exclusion which continues for preference shares. But now imagine just a normal preference share. On redemption, has become a sin asset. You are taxed at 30%. Already you have debentures being taxed at full rate as deemed short term under 50 AA. Now preference share redemption also will possibly attract the full tax rate, and will the any premium you receive on redemption of preference share would suffer a slab rate taxation in one way rather than a concessional long-term capital gain taxation. Buyback under a scheme would be covered. What is the alternate? If the alternate are 2 or 3 in one way, the clearer one is if you don't have accumulated profits or the amount is not so significant, do a capital reduction scheme. A capital reduction scheme is pure capital gain under 45 beyond accumulated profits. So assuming if you only have, say, pure capital, you do a scheme, you pay to the shareholder, it is at 12.5. No debate. If you have foreign shareholders, you want to give dividend, but you want to give only to them. You want to give a partial exit to them. Again, even if you have profits, do a capital reduction scheme. You'll pay the 5%, whatever is the dividend tax rate you'll pay, you'll not pay the 30% tax rate. If you have any business loss, hold the shares as stock in trade. then it will go to business income and not come to capital gain. So any set off possibly would be available. PNL itself, yes, yes. So dividend used to go in other sources. Right now, dividend used to go in other sources, even if it is stock and trade, but buyback will go in 28 only. Yes, yes, yes. And this is the last one is slightly a stretch. If you have shares for, there is husband and wife 50-50 shareholder. If the husband sells 25% shares to the wife, say 10 rupees was original cost, now it is 100. He sells to the wife at 100 rupees. Consideration is received. The husband will pay normal long-term capital gain tax. Now the wife will offer the same shares in buyback. Wife is a promoter, is declared as a promoter more than 10%. No, bro. But what is the computation? You are getting 100 rupees from the company, minus your cost is also 100. So there is no capital gain to levy 30% tax. So it's a academic solution in no academic solution, no practicality to unless one is very adventurous. Gar would come in, even jar will come in, but would defeat the intent. The cost step up anytime would defeat the intent of the amendment. Yes, yes, yes.
Yeah, for SGB, if the right now holder is say second holder, then if he sells before 31st of March, then capital gain would be applicable or
No, yes. So if you sell before 31st March, capital gain is applicable. The relaxation is only if you are able to do a early redemption.
yeah, early redemption.
So,
That's what. Yeah.
so early redemption, then no capital gain till 31st March.
Even so.
So friends, yeah.
Original that person is not the
Not
original.
only. So presently the regime for to cover the topic proper.
Yeah.
For gold bonds, gold scheme,
Yeah.
sovereign gold scheme. Presently, Section 47 provides an exemption that you should, a holder, individual, should do a redemption of the gold bond subscribed in 2015 scheme.
16, yeah.
That is what the phrase reads.
Yeah.
Now, the phrase reads that a person should subscribe, issue, and hold till maturity.
Until maturity. Yeah.
Till maturity. Third, on 2015 scheme or any scheme thereafter. So there are 2-3 important changes. Earlier, only covered a 15 scheme, though each scheme document would say that you are tax exempt, but very technically the exemption was not legislated in so many words in income tax. So that is one. Second, earlier any redemption was covered. So till 31st March, any redemption which would include a early redemption was covered by 47. Going forward, only a redemption on maturity would be covered. So if you after 1st April, if you redeem do a early redemption, you are not entitled to the benefit. You have to hold till maturity. And the third is, earlier there was no condition that you should hold it for the entire tenure. It was whosoever is holding on the redemption was entitled to it. He could have held it at the start, sold in between, whatever. Now it is from start to end. For the entire period, you need to continue holding it. So therefore, answering your question, for next 2 months, one has to, if it is a 2015 scheme, one would certainly do a early redemption. And unless one wants to really hold till maturity, one is fine with that. If one is not fine with that, for subsequent schemes, it is a decision to be made whether you are entitled to the 47 exemption or not, because the language didn't include or any scheme thereafter, which amendment has come in now.
Amendment talks of individual investor, original individual investor, whereas the amendment talks of the original uh, investor.
Right.
And now, say the redemption takes place before 31st of 2026.
Yes.
Then the person who is doing the reimbursement is not the original investor,
So-
but the
Yes. So from 1st April, you will certainly not get.
okay.
Let's put from 1st
Yeah,
April,
that
you
is
have
true, huh.
bought it in secondary, you'll not get.
Yeah.
What I'm saying is, even today, whether you'll get or not is debatable for after a 15 scheme.
Okay. Yeah. For 2015, the person is safe.
Is
But
there?
not.
Yes. Yes. Yeah.
Okay. Thanks.
So, it's 3. So for time, I'll just rush up. We have discussed buyback a lot. DTAA, this is again still. Matt, very. So Matt, now what they are saying is, going forward, Matt is a final tax. You pay 14%, will not give you credit. You want to pay, but 14% no credit for Matt. Whatever you have accumulated, we will not give you a set off till the time you are in the old regime. You come to the new regime, your accumulation till 31st March 26, we will give you a set off at the rate of 1/4 of the tax to be payable every year. So for 22% tax, you can use up to 5.5% of the MAT credit if you have. So it is not linked to the amount of aggregate MAT credit, but it is linked to the amount of tax to be payable this year. So in a way, they are saying we want to just do away with this old regime. Please move to the new regime. We are giving more incentives, and some places incentivizing you to stick to the old regime. So, and foreign companies, so today MAT coming to 14%. If you are paying under MAT, you will prefer that rather than the new regime, because it is at 22. Even you reduce 1/4 of the credit, you are at 16.5. So you'll continue with that. Now, if you do a reverse break even calculation, that when you will be in MAT, you need a 26% deduction of your, say, gross total income. So that in the example, if you see, in new regime, my profit is 136, last line. The 22% rate comes to 30. In old regime, my base profit should be 100. So my rate at 30% comes to 30. So I need a 26% reduction. So my deductions on a broader analysis should be, say, more than 25%. So then I can look at staying back in the MAT regime. So a good amendment for employees. Okay, sorry, this is. So employee contribution, we had Supreme Court to say that if you don't pay by the due date as per the respective act, you will not get the deduction. It is a permanent loss. So checkmate, Supreme Court came in. Otherwise, earlier the high courts were in favor. Now, and before the Supreme Court, a year before, the law was also amended to clarify that you have to pay as per the due date of the respective law. Now it has been completely reversed. Now you have to pay as per the due date of Income Tax Act. So going forward, this is simple that, okay, you will pay as per Income Tax Act. But again, here you have to pay as per due date of Income Tax Act. Otherwise, you will not get it. It is not like 43B that you will get in the year of payment. So if you suffer this disallowance, it is a permanent disallowance. Only the time frame to pay has been extended from PF date to till the date of your return filing. Whether this will be retrospective. The arguments are on both sides. Possible to make out a case that it was a very genuine hardship which the legislature felt after they amended after the court ruling. And therefore, the principles of allied motors, alum exclusion, Supreme Court should apply, even though there was a decision which has been, so to say, overruled. But the jury is out. Gold bond we have discussed. On undisclosed income, 68 series. So if we have to just broadly see what is it, this is a primary rate change, process change. There is no change in definitions on or the coverage of the section. Earlier you were taxed at 60%. Now you'll be taxed at 30%. Penalty on unexplained income was 10%. Now it is 200%. Earlier there was nothing like immunity. Now you will have an option of immunity by paying 120% of the unexplained tax on unexplained income, and you don't file an appeal. Effective from 26-27. So if we have to summarize this, what used to happen earlier, what will happen now? So earlier, if I used to, so if you see, if I declare in the return of income, the first box, from 78%, it is coming down to 39%. So very drastic reduction. If there is a suo motu declaration in the return of income itself, it is like any normal income. So this distinct classification of unexplained income brought in during the demonetization changes is done away with absolutely done away with when it comes to the return filing. We are broadly back to the status quo, except that set off will not be available gross taxation, but in principle it is now at a 30% tax. Now if I don't show in the return, but during the scrutiny it is discovered, so then I have an option that I'll pay a 120% penalty, which is 30% plus 36%, and effectively I'll pay 75%. Today, for income tax return itself, I used to pay 78%. Now, even after the assessment, I am ending up with 75%. Subject to that, I agree and I don't litigate. If I litigate, then I have to pay 99%, which was earlier 84%. Updated return. We'll come to that. So updated return is common for all, will apply to this also, but has a greater coverage. Next. Here, right now what we are discussing is only you declare in your return, you declare in your assessment, you file for immunity after assessment, or you litigate. The fourth proposal is you declare when a reassessment notice is received. That is the ITRU proposal. Yes, we'll come to, we have the effective rate for that as well. Yeah. So effectively 78 has come down to 39. You have an option of 75 and you'll be disincentivized with another cost of say 24% if you litigate. So 75 will become 99. And these numbers would be, further added whatever the interest cost has to be paid. And important to note that the explanatory memorandum carries that this immunity option is applicable from 1st March 26 for AY 26-27 or any earlier AYs. So, this is for other than 68, 69. So, presently, wherever we have 200% penalty on misreporting was not covered by any immunity. Now they are saying for misreporting, we will give you immunity, but instead of waiver of penalty, you pay half the penalty. Instead of 200%, pay 100%. And this they are making slightly for even earlier period. So the option of immunity is coming up for earlier period also.
Yeah. So this suo motu declaration in the ITR would be the original one, revised one, or as asked will be the updated one in the previous slide.
This is the original ITR.
In the original ITR only the SSA has to declare that it's
then then it is like normal income.
Exactly. So then it's not unexplained, it's explained.
No, see, there is a technical debate to it. If you see, even now the penalties are different. 115 BEE, Roman 1 they cover unexplained income declared in the ITR. Roman 2 is during the assessment. So that's a very philosophical debate which started from demonetization and has not ended. How can I say it is unexplained if I am putting that as in? Yes, but has been around. Yes, sir.
Next slide. That is unexplained income and misreporting income. What would be the thin line of?
No, sir. It is unexplained income is your entire 68 series. 68, 69 series is your unexplained income. And there is clause A to F, false books and though that is misreporting. You are right. It may fall in either, but let's put it if the AO is invoking 68 to 69 series, he'll go to 120%. If he's not invoking, but for your business income computation, he's trying to say that there is a falsification of accounts done, then it would go to 100. They have identified there is a overlap. I agree with you. So one more due date for return filing. Now everyone who are at 31st July, there is a split 31st July and 31st August. The split is that people who have business income will have to file by 31st August and partners of the firm will have to file by 31st August. Others continue at July. There was some discussion around trust going to August, but that one is unable to see in the draft bill, in the bill. Sir, this is the one change I thought was positive. Uh, mm. This is on a very lighter note. Yesterday, I had a article entering my cabin saying के सर अभी तो अटेम्प्ट पास पास आ गए हैं ना, तो टाइम 3 ही महीना मिलता है नेक्स्ट अटेम्प्ट के लिए पढ़ने का, पहले 6 मिलता था. So now we have a revised return. Time limit was reduced to 9 months. Now you can file for another 3 months, but with a token fee, 1,000 and 5,000 rupees. So yeah, 3 month additional window is opened. Whether you can file for AY 25-26 is not very clear, though the amendment is effective 1st March. Whether they'll have the utility they'll permit, because for updated returns they have been very categorical that you can file for prior period. Also for immunity they are clear, you can do it for prior period, but for revised return they have not been explicit that it will go for the earlier period. Updated return, the scope is increased. Now fortunately we can file updated return even to revise the loss. Earlier, a loss return could only be updated if it is converting into a profit return. But now, without any additional outflow, even you can file a updated return just to reduce your loss. So that's a big practical relief, and especially not coming at any additional cost. So one could file updated return. Second is the reassessment notice. If you file a updated return, so for reassessment you file the return in 147, so that's an option. To the alternate, you file a updated return, and you file a updated return, whatever tax is coming, you pay a additional tax of 10% on the total tax and interest. So hypothetically 68 income taxed at 30%. So you pay additional 3 rupee as for the tax part. Interest assuming has come to 50 rupee by the time reassessment notice has come. So you'll pay another 4-5 rupees. So if I have to put it broadly, a 20% increase in the outflow would be would be made to file a updated return. But then you get over with all penalty, prosecution, everything is through. So nothing further once you file updated return. I'm unable to decide, is this an incentive to take risk? Is the 10% tax plus interest, a good enough hedge to try and consider?
Have they given any threshold for reduction of loss?
No, nothing.
Or anything? You can just update it.
Yes. Nothing. No restriction per se. Retrospective, we have discussed at the start. FAO, JAO, DIN 144C, TPO. I'll just take a minute on DIN. DIN, somehow the amendment is not happily drafted at all. This is likely to undergo a change when the bill is being passed. And to everyone's surprise, presently the DIN amendment, the bill doesn't say it is retrospective. It is with effect from 1st April 26. So that's a clear miss which would be corrected. What they are putting right now is that DIN is compulsory. They are not doing away with the concept of DIN. So they are saying DIN is required. But if there is a mistake, defect, or omission in quoting the DIN, so only quoting mistake is being trying to be, addressed. That if there is a mistake in quoting the DIN, it will be pardoned if the DIN is referenced in any manner. So there has to be a reference also, that is also they accept. And this relaxation is only for DIN of the assessment order. DIN is to be given for issue of each notice for discussion. All those DIN quoting is not presently dealt by the draft. Only the DIN generation quoting for of the assessment order is being dealt. Now, what if the order is communicated to you and the DIN is generated later? Can it be quoted to you at a later point in time? Or if the DIN is generated after the due date has passed away, whether the order would be still valid? What do they mean by reference in any manner? They are not saying reference in manner as may be prescribed. So they are not saying it would be a list of ways they would be saying. They are saying it should be referenced in any manner. So whether a communication has to come to the assessee that it has been referenced, or the logbook, so to say, where DIN is quoted against the respective order is good enough. So all those questions will arise unless it is, clarified, redrafted to cover a much larger gamut of the subject. Another big practical problem going forward in, I'm told in GST used to happen, but for income tax, first time that assessment order would be passed, sorry, penalty order would be passed along with the assessment order. We were used to that first assessment proceedings are over, you get your stay, you file to appellate, you get a notice for penalty, you say you keep it in abeyance. After CIT or after ITAT, if you lose an ITAT, then the penalty would start. And recently we even have a Bombay High Court to say that you cannot pass penalty order before the ITAT order is out. So this entire process is short circuited. Now the penalty order is subsumed in the assessment order. There would be a single order. Umpteen challenges on the process, that when you'll get a show cause, first you'll get a show cause for the quantum addition, then you will get a show cause for the penalty addition, or you will get both the show cause together. What would be the time frame? They have happily provided that there won't be any interest up to the first appellate disposal on the penalty amount. But if erstwhile up to ITAT order he couldn't have passed a penalty order, rather started with the penalty proceedings, so even the interest burden is shifting or starting faster, and I have to go through this entire rigmarole of defending penalty at the start of the assessment itself. Rationalization. Another is classification of reclassification of penalty to fee. So for penalty, we have friends that if there is a reasonable cause, there should not be a penalty. Whereas fee is normally a automatic levy. So now you are, for failure to get accounts audited, TP report, everything, it has been converted to a fee. So even if there is a reasonable cause, one will pay a fee on. Yeah. So last point I'll cover. So now they have got another scheme on foreign assets for small taxpayers. So there are two limbs to the scheme. First limb is if you have missed disclosing the asset, you have paid the taxes, but it is only a disclosure default. Then if the value of asset is up to 5 crore, you can pay a flat fee of 1 lakh rupees and do away with the disclosure default being there. Second is you have missed offering income at all, or the assets are unexplainable. For that, you have the threshold of 1 crore. Total assets or income should be less than 1 crore. And you pay 60% tax, 30 plus 30. Then you get immunity. The non-qualifications continue as they were earlier, PMLA and other offenses. If the assessment is ongoing under BMA, you are still eligible. If the assessment is over, then you are not eligible. Then, friends, it is more rate change. I think so. I think so. We'll have 5 minutes of Q&A if anything. Then, okay. Thank you, everyone.
So I think everybody has understood Abhitan so well. There are no questions at all. Thank you very much. I would now request my co-convener to introduce the second speaker for the day. साथ में दे.
I think that was a very enriching session. So now we have another speaker, CA Amitabh Khemka. He has over 28 years of experience, specializes in tax cost optimization, transaction structuring, supply chain mapping, risk mitigation, and GST implementation. His industry experience spans telecommunication, pharmaceuticals, manufacturing, IT, e-commerce, banking, and more. He has significant expertise in GST implementation and advocacy, representing industry forums before the Indian government. He was a member of the Working Group on GST, a subgroup of the Empowered Committee of State Finance Ministers. Amitabh also assists businesses in evaluating incentives available in India from the central and state government for setting up greenfield and brownfield projects. He's a chartered accountant and a cost accountant with advanced management certifications from JBIMS and the Wharton School, USA. With this, we would like to welcome our speaker, Amitabh Khemka ji. Now I would request our president to take 1 minute. First, you go sitting on the dais. Okay. Now I would request our Joint Secretary Sunil Joshi to offer a memento to you. Not going on the dais. Not going back. The stage is all yours, sir.
Sure. You can start.
Sorry, this is a bit of nostalgia for me because I remember coming to this location almost 25 years back, and this room was very different then. I think it was that entrance was same, but it was much smaller room. And thank you for inviting because I think I'm coming here for after 25 years into this room. And another reason I would say another nostalgia is I ran a study circle for 3-4 years around 2000. So I'm coming to a study circle also after almost 2 decades. And what is important, I think, is study circle helps the speaker to study. And though there are only couple of amendments in GST, but I'm going to take the aspect from a study circle perspective. So I would push all of you to talk and me to listen, you know. So it's for me, it should be a learning is what I would be looking at. Just give me a couple of minutes. I think he's just setting it up. So on one of my first slides, sometimes we always tend to look at what is the finance bill provisions. But we all know it's a union budget. And we all understand as professionals, what does a budget mean? It all means related to money. So if I can take a question for all of you, what is the India's tax GDP ratio? Any guess? Any guess? No idea. Okay. Okay, so he's saying it is in single digits. Little more? Acha. So how many of them pays income tax? You know that. Yeah. So that will help you to guess a number, you know, what is my tax GDP ratio? Okay. So we have few point of views. He's saying single digit. He said, no, it is double digit and it is 20. And sir is at the other extreme. Wow, can't 20, it is 0.5. Percentage of people paying that. What is the tax to GDP ratio? You could ask because nowadays penalty is more than the tax. No, sir, ऐसा नहीं है. ठीक है, we can be sarcastic. We can be sarcastic about it, but that's not the fact. Tax collection to GDP. Yeah. You're talking about, no, you're talking about indirect GST taxpayers. Direct tax, only 2 lakh people? Okay. Sorry, those who are online, we are trying to connect my laptop on the Zoom. So, yeah, I know. That's why I'm talking to them. That's why I'm telling them that they are trying to connect my laptop on the Zoom. Just give us a minute or more. Good. So, no, so good. So, sir, from where did you get that number? You said what does? And you also gave the source. AI says 11.1. Okay. And from where do you get that number? Again, that's AI. So AI is giving two results. One is 11%. Sir, for you, Gemini is saying now or used to be? So you're saying 26, 27. So future can't be less, no?
Online are also responding 6.7. I think it's just
But that's my machine.
just
But this was not my presentation. Okay. Yeah, so we have got connected to Zoom. We're just putting the presentation on. Sorry, you'll have to help me to even share that, no? So just my concentration is here. क्या कर रहे हैं? नहीं, join as panelist हुआ नहीं था. हाँ, अभी. Share screen. Is that fine? Thank you. Thank you. Sorry for delay to those who are online. Those who are in the room, we could chat a bit and everybody got involved. So let me, generally what I do is before talking about the finance bill, I talk about the numbers because it's finally union budget. And if we don't have the pulse on the numbers, we go from 0.5% to 20%. So you can see how big the gap is, sir. So this is the collection, what you see on the screen. Okay. So if you look at the budgeted numbers for the next year, 44 trillion is the total tax. 28 trillion, 26 trillion is the direct tax. 18 trillion is the indirect tax, including excise, customs, and GST. And out of that 44, if you see almost at the last line, what are they going to share with the states is 15 trillion. So what will remain with the center is only 28. What I want you to also look at is that for 25-26, the GST budgeted number was CGST 10.10 trillion or 10.11 trillion. Now, if you look at this year, what is budgeted? 10.19 trillion. So it is 10.1 trillion, now 10.2 trillion. Now, is that at what the economy is growing? Economy, they are saying absolute numbers, the economy will grow at 10%. So what I budgeted last year, I'm almost equally budgeting the same collection for this year from CGST. So if I compare with the revised estimates, it's 9.5 trillion or 9.6 trillion to 10.2 trillion, which is only 6.3% growth. So my tax buoyancy is much lower if I'm growing at 10% in absolute terms. And if my GST is going to grow at 6%, then my tax buoyancy is only 0.6%. Sorry? So, sir is saying that the reason for all this is the GST 2.0 announcements, where we had the rate rationalizations. And if you look at the overall number from GST, that's gone down because the compensation cess has gone. Now, this is what comes from a central government as far as tax GDP ratio is concerned. So, Circa AI was right and some other AI was wrong. But I don't know, in the next slide, I may be saying something different. But if you look at, these are the numbers which sits in the mind as tax GDP ratio, which is 11.5, then 11.4 and 11.2. And for a moment, I just, out of academic interest, look at 2021. The COVID year, it was exact inversion because we were not earning, but we were consuming sitting at homes. And that is why you see indirect tax GDP ratio is still higher in the COVID period. But later on, again, direct tax has caught up. It was not so earlier and it is not so later. But now if you look at direct tax is 6.9 and indirect tax is 4.3, that's giving you 11.2. My question to all of you is this India's tax GDP ratio? This is the verbatim picture taken from Union Budget document. Perfect. So the answer I have in the room is this cannot be India's because this is unions and this is not India's. And India is a union of state, Article 1 of the Constitution. But this is what sits, even the AI has given the same number. And that is the misnomer you carry in your mind that what is my tax GDP ratio? You will say I'm hovering around just double digit of 11.2 or 11.5. And we forget the collection of the states because no single state will add up. You have to add up all the states. And the data doesn't come so easily. So even her AI was right because this is India's tax GDP. So what you see in the first column of net tax receipts, that is union's tax receipt alone. And what is the tax devolution which is center is sharing with the states? So if you add up the union and the devolution, that will give you that 11.5, 11.2, blah, blah. But what is devolving to the states goes to the states. And then states have their own tax revenue, including the 10 trillion GST, which is CGST 10 trillion. Obviously, SGST will be also there 10 trillion, which was not there in that computation of 11.2%. So the tax GDP, if you want to look for India, you should look at the states' numbers also. And when you add the state numbers own tax revenue, you see you get 17.7, 17.9, 18%. And what is the state's revenue? What is devolving from the center plus state's own. So then you look at, you understand that if I look at the 23, 24, 7.8% is what center is getting, and you add 3.7 plus 6.5, that will go to 11%. So when you look at the tax GDP ratio for the states all put together, it is 11 and center is only 8 or possibly 10. 10 is the states and 8 is the center. And that is what appears on the graph. Where does states get revenue from apart from GST? So how much is that percentage? Absolutely. So these are the numbers if you see. Now look at this chart of India. Direct tax is 17 plus 17.7. Now look at indirect tax. GST 32%, excise 12%, which is your central excise on petroleum products, and state excise on alcohol. You look at sales tax, which is again there on petroleum products and alcohol. And then you have customs. Sorry, sir? You mean electricity duty, you are saying?
No, there is a sales tax on electricity under the different article of the constitution.
So that must be going in others, sir, that's my guess.
It should be in other.
Yeah.
Because there is a 15% tax on the electricity.
But what we forget is that when we look at the central budget, the focus is that when you look at the tax GDP ratio, we saw the indirect tax is not the contributor. But when you look at India, you realize that indirect tax is actually the major one. With that background on the numbers, sir, let's look at what's in the finance bill. I'm taking a couple of them are there only. One is on the place of supply of intermediary services. So what is the current provision? The current provision is enshrined in Section 13(8)(b) of IGST Act, and it determines the place of supply basis the location of the supplier. Now, if it is determined basis the location of the supplier, then if the supplier is located in India and he is providing services to a recipient located outside India, then in this case, the place of supply will be where the service provider is, which is in India. And hence it will be taxable in GST law in India, and it will attract GST at 28%, 18%. And it is not going to be regarded as export of services. And in a reverse situation, if the provider is located outside India, and if the recipient is located in India, because the provider is located outside India, the place of supply being outside India, it will be outside the ambit of the GST law in India. So there will be no reverse charge. But that's the current provision. My question is, why is the current provision like this?
So they changed this, if I recall correctly, in service tax. I think in 2015, they had brought in this amendment so as to disallow this benefit to the intermediate.
Which benefit?
So the commission which the agent earns, there was an assumption by the government that this was being used to get the money outside India, and to curb it, they had kind of gone. This is as far as I understand or recall.
So, not contesting what he's saying, but let's look at it the way I am seeing it. So let's look at the historical perspective, and then we know what's happened and why it has happened and what really happened with this amendment. If you look at the service tax law in 2009, I'm saying 2009, an exemption entry was brought in to say that services provided by a commission agent located outside India and engaged under a contract or agreement or any other document by the exporter in India, exporter of goods, to act on behalf of the exporter to cause sale of goods exported by him. So if an exporter of goods was exporting his goods outside India and he needed help or services of a commission agent located outside India, the objective was to provide exemption to that. Now, what was happening prior to 2009? These services were attracting reverse charge. In 2006, you had import of services rules. Now, exporters had to pay first service tax under reverse charge mechanism. They would export goods, then claim refund of that service tax which they paid on commission agents, and it was blocking your working capital. And to release that working capital blockage, the exemption came. Now, the challenge for the draftsman was that how do I take this when I come in the negative list in 2012? So in 2012, you had the place of provision of services rules. And to ensure that this benefit to the exporter of goods is given, he came with a novel idea that let me define intermediary, which will involve this commission agent. And let me say that the place of supply will be basis the location of the provider. And the moment that commission agent is a provider, the benefit which was given in 2009 can be continued even after July 1, 2012. Now, my other question is, how can the lawmaker say that for this, I will say it is location of provider? For many services, he is saying it is recipient based. For certain services, he will say it is provider based. How can he say that? Or can he say that? How? Why? From where? From where do you get that he can provide either? That's the question.
Because
service tax law for it to
No,
agreed.
no,
Agreed.
sorry.
Just
So my question is, if you are the draftsman
ah,
and you have to write it for the first time, which somebody wrote for the first time in 2012, how did he think that let me change, because my default provision is service recipient based, location of the recipient. Now, if my default is location of recipient, and as he said, accrues or arises in India, then I'm bound to think like that only. But somebody thought differently and out of the box and said, let me bring a definition of intermediary, let me take it to the location of the service provider. I'm saying, from where does that concept comes? So then the consumption is happening in India. And you are saying, let me do place of provision basis the provider. How? The provider is there, no? In case of commission agent giving services to us,
Yeah, on the reverse side, it is correct. Reverse side.
then it is not consumption based. Sir, you were saying something. But which is not happening.
Paying for imports.
No, but in this case, by making the location of the place of provision of service as a location of provider, I have taken that services out of the tax net itself. So there is no reverse charge. There is no import of service per tax. So the point is, so VAT का I just हम services की बात कर रहे हैं. No, we are not discussing that. So see, the point is place of provision of service or place of supply is a proxy. There is nothing in that sense called destination-based consumption tax. What will decide if I have a bungalow in India and I reside in UK and an architect in UK gives me that design? You will say consumption has happened in India because the bungalow is in India. But that's the place of provision of service. Look at where the property is located. So the consumption-based tax is what came in the Supreme Court judgment. But if you look at the place of supply, it's a proxy. The lawmaker may decide for this, I will give a proxy of either the location of property or location of the event or location of the performance or recipient based or supplier based. Now he will tweak the way he wants it for his country and his regime.
That is how the Section 13 is drafted.
Correct. And that's what I was looking at. How did he think and how could he think? Because conceptually place of supply is a proxy. Proxy means मैं जो करना चाहूँ कर सकता हूँ. And that's what he used and brought the intermediary to the location of the service provider. The moment we understand this, possibly one of the questions which is forthcoming will be easier to answer it. But that's the historical background. But why is the amendment coming? Because export का benefit नहीं मिल रहा था.
Possibly, if I'm a commission agent in India, I would end up paying 100 rupees.
But that was never the intent.
Paying income tax as well as
But that was the intent. In 2009 also, that was a provision. So what is there to crib in 26? When you didn't crib in 2009? Why and what has changed?
Service providers who are handling such transactions to give them the benefit of exporting.
So I look at it differently. Situation has not changed. The administrators started reading intermediary in a different connotation. BPOs, KPOs, everybody became intermediary. And everybody was pulled into the definition of intermediary, who were not intermediaries also, or who were never intended to be intermediaries. So because the gap between the lawmaker and the administrator, that why am I bringing intermediary? What is my objective of bringing intermediary? And somebody who's even writing accounts for a foreign company was called as intermediary. In one of my cases, if I was doing US tax returns, I was called as intermediary. So lot many people were pulled into the definition of intermediary which was never intended. And possibly what sir is saying is what has changed in my mind. I mean, I have no data and I looked at data, but that I didn't get any data from RBI. How much commission was paid in 2009 by Indian exporters? And how much commission is being paid today by Indian exporters? That data is not at least readily or easily available. But my guess is that thing has changed. In 2009, possibly as an exporter, I didn't know how to go, where to reach out, how to go to the market, and I would need some commission agent to help me. Possibly that scenario has changed. In that backdrop, the change is to omit section 13(8)(b), because the intermediary service provider definition was being applied largely to people who were exporting services, and not only commission agent, but all other than commission agents were being pulled into it. And that was the representation to the GST Council. And that is where, to address that, it got amended. But I hope all of you have gathered that with 13(8)(b going, all the commission agents' relief which was available till today will now go back. The exporter of goods will have to pay GST under reverse charge mechanism. There will be a capital blockage, and then he will have to claim refund. So just to read what is there on the slide, Finance Bill 26 proposes to omit 13(8)(b. And the notes and clauses also says that it will omit 13(8)(b so as to provide that the place of supply of intermediary shall be determined as per the provisions of 13(2). Because the moment I am saying 13(8)(b goes, then the law says that anything which is for which it is not provided, it goes to the default section, which is 13(2). This is the location of the recipient. Now the only question is, this word shall be omitted. Does that has any significance? What happens to the existing cases? Sorry? So the lawmaker is proposing shall be omitted. That's all. So now, sorry, sir.
Is going to repeat where there are notices issued as of today. Once this amendment comes, the matters that are decided after that, they are going to have to follow this. Unless they put a savings clause, meaning that it applies.
So what is interesting in my view for the proposition what you're bringing, and just to people who are online, what sir is saying is that if a rule was omitted, then the implication which is there in Rule 96(10) litigation, will that paramateria be same when a section is omitted? So that's the another consideration which has to be kept when a subordinated legislation there's an omission, and when in an enactment there is an omission, it may have a different implication. But I'll leave a thought for all of you. I don't know. I will definitely not have an answer. I'm not a lawyer, but I'm picking up something from the law books to say that what GP Singh is saying. And this is a verbatim extract from his book. When the object is to repeal when the object is to repeal only a portion of the act, words shall be omitted are normally used, which has happened in our case also. The legislative practice in India shows that omission of a provision is treated as an amendment, which signifies deletion of that provision and is not different from repeal. It has been held that there is no real distinction between repeal and an amendment. And if you look at the notes on clauses, the notes and clauses is saying that because I am repealing 13(8)(b, it is going to 13(2). So, but I would leave as an open question, what happens to the existing cases? And can tomorrow tax officers issue notices for the past period if the word omission is there? Yeah, everything. So I read all the case laws. He had taken interest in this aspect. So there are uh, five judges, two decisions of five judges, where they've evaluated what is repeal. There is an obiter dicta talking about between repeal and omission, but there is no direction or there is no judgment or there's nothing being held by the two. There are later on judgments by two-member bench which do not agree with that five-member bench to say that what is the distinction between repeal, omission, and substitution. And that's where, and GP Singh also evaluates all the judgments. But then I could see that this portion actually gives a direction very clearly. Matlab, don't apply too much, it is an amendment, full stop. I'll go to the next proposal, which is on post-sale and post-supply discount. And what I'm doing on the screen is I'm giving you a comparison between the current provision and what is being proposed. So this is section 15.3. Section 15 talks about value of taxable supply, and 15.3 speaks about or specifies the value of supply shall not include the discount. What is being currently provided is that if the supply has been, after the supply has been effected, and the discount is being given after the supply, discount is given after the supply has been effected, such discount has to be established in terms of an agreement entered into at or before the time of such supply and specifically linked to relevant invoices. So there ought to be a pre-agreement for a post-sale or a post-supply discount. And input tax credit as is attributable to the discount on the basis of document issued by the supplier has been reversed. So the recipient of the credit note or the recipient of the discount has to reverse the ITC. Now, what has been removed, if you see, B1 has gone. The agreement. B2 remains almost same. So the pre-agreed discount aspect has been proposed, is being proposed to be removed. It's as simple as that. And then they are saying that you should issue a credit note in accordance with 34. And let's look at what is 34 first. And in the again, you have a comparison of the old provision and the new provision on your slide, where what you see on your right, the bold letters is what is being proposed to be added. So if you look at the current provision, it says, when will you issue the credit note? When the taxable value or tax charged is found to exceed, or the goods supplied are returned, or the goods supplied are found to be deficient. One more or is added, or whether discount referred in 15.3b is being given. They added straight away, you give if you're giving a credit note or you're giving a discount through a credit note. So let's go back for a moment. So here the law is saying that if you are giving a credit note in accordance with section 34. The 15.3 earlier was not talking about credit note. But you will bound to be issuing a credit note with GST, then only you will be taking it. And what is the objective if we look at notes to clauses? Clearly, they are saying the requirement of linking postal discount with an agreement of the relevant invoice has been done away with. That's all. So I think the provision is very simple. I'm not getting into the 15.3b2 because that is remaining same. How do we go about it by taking that confirmation or affirmation that he has reversed or not till IMS gets compulsory or mandatory, and there is a circular or a clarification that you take a CA certificate and all that, that one will have to follow because there is no change there. For secondary discount, everything will remain the same. Yeah. Yeah. My only point here was, if you look at the notes of clauses, the bill seeks to amend section 34 of the CGST Act so as to include reference to discount for issuing credit note for post-supply discounts. And now if you see here, the words are, you may issue to the recipient one or more credit notes. Now, is this may for one or more, or is this may for the credit note itself? So I think it is very important for us to know that when standard credit rules was dying out, or when it was supposed to come, the standard credit rules had an amendment to say that if you have received a credit note, then you will not be given standard credit to that extent. So let's say, for example, I have issued an invoice of 100. So the taxable value is 100. So what is the value of service? 100. What is the value of input service? 100. Now, if I give you a credit note, then the value of input service itself has come down to 80. So if you have not received the value of 100, how can you take the credit of 100? So it's my guess those kind of Pandora boxes may now start to open. Somebody will get into after this amendment to say that if you are arguing it is a financial credit note or it is a credit note not coming under section 34, please prove that it is not reducing your taxable value. If it is reducing your taxable value, the recipients might be pushed back to say that you didn't receive 100 rupees ka value in my example. It was worth 80. I can see a credit note coming. Why shouldn't you reduce your ITC? Because you never received value of 100. So only the first guy and the last guy and all middle can stop paying tax. Ah.
No, because that is a fair point. Because one of the argument, even without 250 or 90, one of the
Still possible.
Yeah. Earlier the point was that where do I bring the credit note? Now that they have brought it that this is where it 50, 34 are linked. Now that argument, that's a fair point. That argument will still come. Then why is it not a why is it a financial credit note?
Yes.
The non-payment clause will also get trigger.
Yes.
But for that, they issue the same. It does not, financial credit note would not mean a non-payment. So that part they've clarified already. For that, they also said credit should not.
See, the moment it is a financial credit note, that discussion doesn't happen. These are some of the other proposals. The provisional refund of the 90%, which is currently there for exporters, they are proposing it to extend it to inverted duty refunds. Currently, up below 1,000 refunds are not allowed to exporters. Now they're saying we'll grant you. And the National Appellate Authority for Advanced Ruling, they are saying that because it is currently not constituted and possibly the tribunals are getting constituted. And if you see the constitution of these authority, appellate authority and the constitution of the tribunals being same, it is being proposed that one of the tribunals or the tribunal would be, now which bench of tribunal will be regarded as an appellate authority, we need to wait and see. The only thing which I could not gather, and if any of you can throw light, all the amendments are to be made effective from a date to be notified. But this amendment is from 1st April 2026. So I'm not sure what was so much key to make this amendment from 1st April and all others from date to be notified. That's all what I had, friends, today. Thank you. Thank you for the patient listening.
No. Any questions? Not there, not there. Anyone here would want to ask any questions?
Sir, the amendment for IGST will come before the central, before the CGST amendments?
There are out of the 6 amendments that are happening. For 4, they have stated from a date to be notified. For 1, they have stated from 1st of April. And the one for intermediary, it is going to be as, because they have not specified any date. So as soon as this bill becomes act, it is going to come into effect. Correct understanding whether it is correct.
Correct. It was there on my slide. I may not have spoken about it. That intermediary will be from the date of enactment of the finance bill.
Being the central act, and therefore the others being in CGST.
No, section 1, 2 of the finance bill specifies which provision will come from which date. And if one subsection 2 of section 1 of finance bill is silent, then for all those provisions where the law is silent, it will be effective from the date of enactment of the bill.
And just a side note to, again, with regard to this effective dates, where you rightly stated that for all the others, it is from a date to be notified. Now in GST, it is presumed that it is always put from a date to be notified because they are waiting for all the states to also make their amendments, respective state acts, and then on one single day, all central and state amendments come into effect.
Correct.
For this particular thing, 1st April 26 is given without waiting for any state.
Correct.
The reason appears to be because even at the time of that 56th council meeting, the finance minister clearly stated that I have directed all the CBIC field formations to start issuing even without waiting for an amendment. At that time also, it was only the central people who were directed. The states were not directed. So whether or not the states amend their act, when, as and when they amend, for center, we are going to start implementing this. That appears to be the
But
reason.
here there's a situation is different. I'm only saying which bench will be the appellate. So assuming
No, I am only talking about the part of the inverted rate structure, or that is also from a date to be notified.
date to be notified.
That is also from a date. Okay.
So
that National Appellate Authority for
is only that one is from 1st April.
Understood.
No questions. Any more questions? Okay. On behalf of GSTPM, I sincerely thank CA Abhitan Mehta for an insightful and engaging discussion on the Finance Bill 2026. Despite having a bad throat, he delivered the session with clarity and ease. Thank you very much, sir. I also extend our sincere thanks to CA Amitabh Khemka for his insightful and practical explanation of the GST perspective of the union budget. Both the speakers not only decoded the fine print, but also kept us alert and smiling throughout the session, which is no small achievement during a post-lunch meeting. Thank you for sharing your time. Thank you for sharing your time, expertise, and wit. We truly appreciate it. Your clarity made the union budget far easier to understand, at least until the next amendments and circulars arrive. Thank you so much.
Just on a side note, Mr. Abhitan, lot has been spoken about your throat, but you are still the hero, not your throat. Huh?
Just one photograph for he wanted to take, and one announcement for tomorrow's.
So I'll just do an announcement. Praveen, just take the mic on me. Praveen, मेरे पे mic डालो. Camera, sorry. Okay, to all the participants who are there, see, we've had a great session today, and tomorrow we have a beautiful session which we are starting the rules of interpretation and GST, where the keynote speaker is going to be Rafiq Dada, senior advocate, and then it is going to be followed by Sridharan sir. So whoever has missed out, please do register at the earliest. And even if, say, for example, somebody told me February है सबका शादी का time, सबका अलग अलग शादी जाना है, we have decided that we are going to have video access for 1 month. So please enroll at the earliest, and tomorrow please do not miss. We are such big doyens, we don't get a chance every day. So for everyone who is here and the ones who are listening to me, please enroll for the interpretation of statutes and GST webinar. Please do so. Thank you. And there are going to be 5 lectures over the next 3 weeks. It's all on Saturdays. So it's a webinar. So please do. And you can view the video later also.
Yeah. And we will also circulate the QR code on all the member groups, and it is also available on the website to register. Now, please rise for the national anthem. नमन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाए तव जय गाता जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 जय